while these chairs are coming off, I would like to tell a little story about John Chang. So I found John Chang 5 years ago, reached out to him cold, and he has been coming back every single year to talk about his economic predictions and insights and how he sees the world of commercial real estate, because every single year you all rate him as the highest rated speaker. He offers the best insights in engaging storytellers. When I talked about that value that we have of content on the very first day, John Chang embodies that value above all. And so I'm very excited. I always come down and sit down to see what does John have to say, because if there's one person that I want to call to see what I should be doing tomorrow that I'm not doing today, who has the data, who has the insights, but more importantly, who has the ability to digest those insights and give me a story that I can attach something to, who can understand where I'm at and move forward with it, it's this gentleman right here. So, welcome back for the 6th year running, Senior Vice President of Research and Insights at Marcus Millichap, Mr. John Chang.
Tomorrow we hanging over till we start feeling sober. Then it's time to start it over. Here we go again.
All right. How we doing? Everybody good? Everybody having fun? This is a fantastic conference. It's my favorite conference of the year. I truly enjoy talking to everybody here. Now, these are interesting times. Literally, I went back and redid my whole presentation yesterday, as all of the news that's coming in is changing the landscape every day. And I got to warn you up front, I don't want to scare anybody. Just there's a lot of things going on. I don't want to take a negative perspective or anything, but there are a few headwinds. We have to consider that as we define our investment strategies going forward. And of course, our biggest economic wild card this year is our new president, our new administration. Oxford Economics nailed it. Buckle up. Trump era brings economic uncertainty. We don't know what's around the next corner. And whether you love him, you hate him, whatever, it doesn't matter. The thing is that it's unpredictable. And that is holding true very much so over the first few months, or the first month of his presidency. Who saw the debate on Monday? Anybody? Yeah, a few? Okay. So the thing that was crossing my mind as I'm taking on the debate, did we get a soft landing, really ties to what I see here.
Whoa, whoa, whoa! Whoa! We're getting that go around, holy moly!
So we got close. And the wheels are on the ground, it's bumpy, and they're going up and going around, and where it goes from here, we'll have to see. But there are challenges, and by definition, I'm saying, hey, a soft landing means we got inflation fully under control, and I don't think we did that. And as we look forward, I'm looking at 5 things that I think are the big predictions for the year. I went out on a limb with some of these, so hopefully we'll look back a year from now and say, hey, that was we nailed it. So first of all, tariffs are a significant inflation risk. We have to look at all the news headlines and the challenges it's going to create. Whether they stick, look, they were put in place yesterday with Canada, Mexico. We doubled up on China to 20%. They could be all gone today. I don't know. Maybe tomorrow, maybe next week. It's the unpredictability that is going to cause waves through the economy as we move forward. So the headlines are capturing some of that uncertainty today, and that's going to be a headwind for investors because it makes the outlook unpredictable. If they stay in place, they are going to be inflationary. You're talking about 41.5% of our total imports are now under these tariffs. Mexico is our number 1 trade partner, then China, then Canada, and they're bringing a lot of goods into the United States. If you keep tariffs on there, that pushes the price of goods up. That creates inflation. There's comments about whether or not it's a temporary thing, it's a one-time lift. Yes, I believe that's true. However, if we're moving them around all the time, it's not a one-time thing. It shuffles. If we go out and put tariffs on Europe next, then that adds to the mix. So just bear in mind, these things will create inflation, and how that plays out could create some challenges. When you look at the areas impacted by just Canada, Mexico, and China, you have food. right? Not all of the, but a lot of the fresh produce is coming out of Mexico. I don't know, we get maple syrup or something from Canada. The consumer goods, all of our phones, a lot of our clothing is coming out of China, and we see a lot of the goods coming out of Mexico, like computers, China, we get toys, and then construction materials. We get a lot of our lumber from Canada. We get a lot of the gypsum used in the sheetrock from Mexico. So these things are going to create headwinds for the economy. When you look at economic growth, we're still predicting, or the blue chip economists still predict 2.2% growth. That's a month old, right? That came out on February 10th. I get a new update on March 10th. That probably won't capture everything yet. We won't see the new true blue chip forecast probably until the April release on April 10th. But that's what they're predicting right now is 2.2% economic growth. You can see Goldman Sachs at 2.5%, all the way down to Wells Fargo at 1.6%. But we do know that tariffs pose a risk to our economic growth. That's estimated somewhere around 0.5 point for the year. We may be looking at another 0.5 point, depending on what happens with our immigration policies and deportations. Those are risks we need to consider. And whether we believe they're going to be fully implemented or not, we do know that it is creating uncertainty in the marketplace. So if you take that inflation aspect of tariffs, you could see that right now our CPI is at 3%. It had been coming down. It actually has ticked up over the last month, and we could be at about 3.5% inflation by the end of the year with tariffs in place. If they get washed away and we get rid of those and we don't implement them fully, then it could be something less than that. If they double down on it, it could be more. So that is a risk that we have to bear in mind as we look forward. The next piece is immigration. Now, when you look at the job creation, it has been pretty good. Where is our slide? Let's see here. There we go. If we look at the job creation, it has been solid. And remember, the Fed has been trying to slow down our job creation in order to reduce the inflationary pressure of wages, right? So at the height of the inflation cycle, we were up north of around 6% wage growth. Right now, it's come back down to about 4.1. That is still elevated. Historically, the norm is about 2.6% wage growth. We're doing 4%, and so we're still elevated. We saw the pace of job creation slowing down. It's been bumpy, but generally it's been good. Now, a lot of people talk to me, and this comes up time and time again. They say, well, you know what? We got a whole bunch of lazy, 20-somethings that aren't out there working, but the data suggests otherwise. The labor force participation rate of people between 25 and 54 years old, that is the core group of workers in our country, is basically at its highest level since 2002. There is very little slack in the labor force today. The participation rate of young adults, all the way up into their 50s, is really actually quite high. It's come down a little bit in the last couple months, but it's right up there in that mid 80% range. So labor force participation is high with that core group. Where you see the trailing off is actually the baby boomers. People 60 and older have come out of the workforce more greatly than others. But I'm a little concerned about deportations and immigration policy. So again, you see all the headlines. We are talking about this. This is out in the news media, and deportations could have a significant impact on the economy in a variety of ways. So first of all, we have job openings. Now, back in 2021, we started to see more job openings than we had people who were unemployed. Actually, it started in 17, 18, 19. Then we had the pandemic, and then it spurred up again. So we have more job openings than we have people looking for work. And then there's, how well people fit into different jobs, where they're located, et cetera. But it is not normal for us to have a labor shortage in this country. Historically speaking, we did not ever have this until we were we had it a little bit during the dot-com period in the late 90s, and then again starting in 2015, 2016. And one of the key ingredients to that is immigration into the country. All right, so you can see during Trump's previous administration that there was downward pressure on immigration to the United States. And at the same time, you can see that the labor shortage started to pick up. We had more jobs than people looking for work. Then, of course, we had a change of administration, and we went the other way. We turned the floodgates on and just turned everybody loose. We had massive immigration into the country. But our labor shortage shrunk from 6.2 million in 2022 down to 750,000 currently. So by allowing more immigration in the United States, we helped solve the labor shortage that slows down economic growth. In order to have a business running, you need people doing jobs, and that filled a lot of that need and that demand. So as we look forward, we may deport some people, and again, set aside any political bias here, we may deport people. But I'm actually more concerned about the chilling effect that has on legal immigration to the United States, which we saw in the prior administration, and that could reduce the number of people who immigrate to the United States, and as a result, our labor force could encounter a challenge. All right, so we have to think about all the areas that could be affected. We're talking about construction, we're talking about agriculture, we're talking about healthcare, and we're also talking about hospitality services. So these are all areas where you're going to feel the most pressure, you're going to see the most pressure on the labor force if we tone down our immigration, which looks like something we are going to do. And I'm not taking a stance on that. I'm not saying, hey, right, wrong, or indifferent, but I'm saying we will see fewer people to fill the jobs that we create through economic growth, and as a result, it will put upward pressure on wages, and that is inflationary. So if you take the deportations and the tariffs and you stack them, we could be getting towards 4% inflation again this year. Now, what happens when we have inflation starting to go up? It makes the Fed a little bit nervous. They start to reduce their probability of reducing rates, and their downward pressure on rates. They want to slow things down. They put upward pressure on rates, and that creates a challenge, which brings me to my third prediction, which is that interest rates will be volatile this year. Okay? Now, we've already seen this. They're bouncy, they're moving around, and that's because of the uncertainty as well as all of the other moving parts about economic outlook and where we see things going in the coming year, and as a result, the interest rates are going to move. Over the last couple days, we saw a flight to safety out of the stock market and into bonds. That put downward pressure on rates. They came down, 20 basis points. And then the money's going to move back. Already the stock market is starting to bounce up again. The rates have started to trend up again. So you can just count on the idea that the rates are going to be bumpy this year. Now, right now, 415, actually 425 today, they're right on the 35-year average interest rate. This is quote unquote normal. Now, when I talk to investors, they say, well, when are rates going to be normal again? And I'm like, how long have you been in the business? Because if you've been in the business 15 years or less, normal is 2.25. For those who were in the business in the early 2000s, 4.5 is normal. For the 1990s, it's 6.5. Those who have been in the business even longer are just really old, and they don't remember anyway. But the point is that what is normal in people's minds is contextual. And so it's really hard to understand. When I talk to Moody's Analytics, they're saying 4.5 is probably the target. I'm inclined to agree. Somewhere around 4.5, but very volatile. 4%, we could hit 4%. We could hit 5%. We're not certain. So as you're looking at deals, when you're out there finding an asset and you're looking at your financing, if you're buying on the dip on interest rates, get it locked fast because they can move again very quickly. So you have to be ready with your deals. You have to be prepared for fast action when the time comes because the rates are going to be volatile. And that's going to create a challenge. And behind all of this, you have Chairman Powell. Now, honestly, I believe he's done a good job. He's been a little slow on the move sometimes. Sometimes he's not moving fast enough. Sometimes I think he's moving a little too fast. But you got to remember, he has a really tough job. I mean, look at him. This is 2016. He became the Fed chair in 2016, and he was bright-eyed, bushy-tailed, ready to take on the world. 8 years later, I mean, the last 8-9 years haven't been good to me, but that's rough, right? That's like really challenging. You just have to, I feel for the guy. It's not going to get easier. This is not going to be a good year for him. He's fighting away. He is working in our best interest. He is trying to keep the outlook balanced. He's trying to keep inflation under control. He's trying to keep the economy balanced through the tools that he has. And this year, he's going to be dealing with volatility. Now, I've mentioned this before. Some people may have heard it. There's something called an uncertainty index. The uncertainty index was invented by a top economist out of Stanford, another one out of Chicago. And they came together and they started tracking uncertainty in the media as it relates to the economy. And I mentioned this on the debate the other day. The uncertainty index is at the second highest point in history, right behind the pandemic. All right? It's greater than the global financial crisis, the European debt crisis. It's higher than when the government shut down. It's higher than Brexit, and it's even higher when Sharknado came out in 2013. And that was, I don't know what happened that year, actually. I just found that in some website. Anyway, uncertainty is elevated. That's going to change decision making. You don't know what's around the next corner, so you hesitate. Businesses will slow down their investment into infrastructure. They may slow down their hiring. They don't know what the rules of the road will be. And Chairman Powell kind of summed it up in a roundabout way. With our policy stance significantly less restrictive than it has been, the economy remains strong. We do not need to be in a hurry to adjust our policy stance. Now, that was code for we don't know what's around the next corner and we're going to stay still. We're not going to do anything until we have clarity on what's happening. And that was in January. I'll bet you right now they're even more concerned because they don't like uncertainty, just like the stock market doesn't like uncertainty, just like business owners don't like uncertainty. So they're going to hold back. When you look at the outlook for rate cuts, I use FedWatch. They basically track the values and the movement into and out of bonds to assess the probability of rate cuts in the future. I have June and December here for the targets. And this shifts. Sometimes in a day, it could shift 10 times. This is the latest one. We pulled it up yesterday. And right now, the bond market is saying, hey, we still should have 1 or 2 rate cuts by mid-year and another few cuts by the end of the year. And I think that's really tied to the outlook on economic growth. There is concern that economic growth will slow down. We had the Atlanta Fed, the Atlanta Federal Reserve Bank came out. They said that their model, not touched by any people, just mathematically, was saying 1.5% decline in the economy. That was last Friday. Yesterday, I think they came out with a revised number and saying, hey, first quarter economic growth is going to be negative 2.8%. Now, there's a lot tied into that, okay? The tariffs are coming, or everybody knew the tariffs were coming, and they front-loaded their imports to get ahead of those. So you had this real disruption on imports and exports that caused negative GDP growth and pushed that negative. Theoretically, it'll stabilize in the second quarter. We should see a bounce. But there are cracks that are starting to appear in the economic outlook. And because of that, people believe that the Federal Reserve is going to intervene and that they will reduce rates to spur economic growth. The one challenge with that is if inflation is going up at the same time. The one thing that the Fed fears more than anything else is that the Inflation will rise as the economy slows and we get stagflation. And the playbook says, the Volcker rule says, in that case, you raise rates. Now that's concerning to me. The other part of this that we have to consider is, it's all about supply and demand on treasuries, right? The 10-year treasury. And the issuance of treasuries has been elevated. It was elevated in 24 or 21 with the pandemic. And it will probably be elevated in 2025. They haven't set a budget for 2025 yet. It looks like it will be a deficit-based budget when it finally gets squared away. And we might not get a budget in place until late in the year. So it looks like it will still be a deficit-based budget. That means more issuance of treasuries. And at the same time, who's buying them? The Federal Reserve is allowing $25 billion of treasuries to roll off their balance sheet each month. They're not buying as much as they used to. China is not buying as much as they used to. Japan is not buying as many treasuries as they used to. And as a result, the buyer pool for treasuries has shrunk, and our distribution of treasuries has increased, and that has put upward pressure on the 10-year treasury rate. So as we look at the Fed funds rate and the treasury rate, I'm still sticking with 4.5% on the 10-year, plus or minus 50 basis points, bumpy and volatile. So that's where I see interest rates going. Now, I'm going to shift gears, talk a little bit more about something a little bit happier in a weird sort of way. The housing shortage. Depending on your perspective, that's good news or bad news, right? And so, in our good side, we're saying, hey, housing shortage is bad because people don't have housing. On our investor side, it's saying, hey, that's not too bad because that means our demand for apartments is good. But look at this. This is the population by age, all right? So that millennial generation, 73 million, that's a big, giant group. It's bigger than the baby boom generation, which is about 72 million. The millennial generation is still in a prime household formation range. They are still in a rental market. If you look at the median age of home ownership, the first-time home purchase, it has pushed out. It is now 38 years old, okay? That 2 years ago, it was 36. In 2020, it was 33. 2010, it was 30. Before that, it was in the 20s. That was the median age to buy the first home. And there's a lot of reasons for that. The cost of houses has gone up, the affordability, the interest rates, mortgage qualification, but it's also about quality of life. The apartments we build today are very, very different than the ones that were out there in the 80s, 90s, 2000s. And the quality of life in a lot of these apartments is very high. And so for the first-time home buyer, they say, well, if I could find a house that I can afford that has the same quality of life that I'm getting with this very, very nice Class A apartment and is in a great location like this apartment, then I would go buy it. But there's nothing I can afford. They don't want to go out and get the starter home and start working on it like I did or many of you may have. So there's a disconnect there, which means we have people renting for longer than we have in the past. At the same time, we're not building enough houses. You look at the single-family home builds per 1,000 households, and it is still very, very low. Not as low as it was following the financial crisis, but it's still very low by historical standards. And the entry level is just a minuscule piece of that. So there are not enough houses being built to meet the total demand and to drive down the pricing on homes. When you look at the home prices, they're up about 6.1%. A lot of people thought that the home prices would fall after the interest rates went up. They did for a little bit, but it was very short, and they started moving up again. There is still a housing shortage, and there are not enough homes to buy on the market, and the sales volume is still very, very low. The affordability gap between a payment on a home, a first-time home, a median-priced home, which is not an extravagant home, by the way. That's traditional, 3-bedroom, 2-bath, 1,700 square feet, something like that. The gap between your principal, interest, taxes, and insurance relative to the average rent in the United States has opened up to its widest level on record. It's pushing $1,300 a month differential. So there is an enormous gap out there. And just as importantly, the loan qualification criteria per Freddie Mac, based on your front and back ratio, only 27% of households can afford a loan. They can qualify for a loan because the income levels simply aren't high enough to manage that front ratio. And so it's very small. Traditionally, it was close to around 50%, and that's been suppressed over the last few years. And that probably won't bounce back because the home prices are not coming down and the interest rates probably aren't coming down anytime soon. So that's a challenge. When we look at the impact on our rentals is we see greater lease renewal rates. We see upward pressure on that. We're not losing as many households out into homeownership as we have in the past. And when a lease renews, it has a higher rent growth than bringing somebody in brand new, because you oftentimes have a lot more concessions on that on that renter when they first move in, so you don't have the same level of rent growth. So this is a positive for multifamily owners. This will give us some momentum there. Also, when you look at the absorption relative to construction, now construction last year was off the charts, record high construction, but in the second half of 2024, we saw a surge in household formation and new rental households that pushed absorption actually above the pace of construction in the fourth quarter. Now, I can't say that that's going to hold, but that is definitely a positive because nobody was really expecting that level of absorption last year. When you look at the outcome of that, you can see that in 2024, we had close to 600,000 new units come online. You got to go all the way back to the 70s and 80s to see numbers like that. The pace of construction has slowed down a little bit, 410,000 forecast for this year. We had vacancies come down a little bit nationally, on average, nationally last year, and we're still predicting that it nudges a little bit lower in 2025, down to about 5.1% for the year. So we still have a little bit of downward pressure on that. But remember, circling back to our first topic, tariffs. When you look at the imported materials by country, you see lumber is, a significant portion of our lumber is imported. A lot of it coming from Canada. Steel, copper, cement. A lot of our building materials are being imported. And so if we have tariffs, the cost of those building materials goes way up. I want to quickly address the idea that we're going to be able to open up a lot of areas in the U.S. for clear cutting or to satisfy the lumber needs in the U.S. You got a problem that's not factored in there yet, is that they're targeting some old growth forests that have a bigger tree trunk size, and the mills are not set up. The lumber mills are not big enough to handle big trees. They're all designed to handle small trees now. So even if we start cutting down more trees in the U.S., we don't have the capacity to transform that into lumber at this point, and that will take a lot of retooling, and the mills will have to be changed. So that is not a good short-term solution. So we're going to see increased lumber prices as a byproduct of tariffs if they're put into place and they're sustained. So basically, the cost of construction goes up. So we're already seeing a downward pressure on the pace of multifamily construction. If you look at the units under construction, we're 41% off the peak, and the number of starts are down by 76%. This data is before the tariffs were put in place and before the immigration is fully baked in. So we may see even less construction, which means multifamily gets stronger. Vacancy rates come down, rent growth improves. Those are the end result of all of these pieces as we go forward. Now, when you look at the financial markets, they become very volatile. You look at that economic uncertainty index on the bottom, And you can see that the volatility index of the stock market is jumping in response. And that's why I'm talking about. The volatility of the investment climate gets more exacerbated the longer that the uncertainty is sustained and the stock market becomes volatile. And as a result, we see more capital shifting from a highly volatile stock market into things that are less volatile. When you look at cap rates, they've recalibrated. They're up significantly compared to their peaks. Now it has 2021. Multifamily actually had the lowest cap rate in 2022. It's up 130 basis points off of that bottom. But you can see that all of these different types of real estate cap rates have moved up over the last 2 years, increasing the yields that are out there today. So the market has recalibrated to the current climate. It's razor thin, right? You can't go out and get positive leverage like that. The investors I'm talking to are saying, hey, if we can get close and through value add, move that number to positive leverage within 2 years, we're going to take a swing at that deal. So there's opportunity there. There is still a significant volume of capital targeting real estate. These are the pre-Quinn numbers. We still have $200 billion of dry powder. I mentioned it last year. Actually, at the beginning of 2024, we had about just north of 300 billion available. A lot of that got deployed last year, especially in the fourth quarter, but there's still a lot of dry powder available. So, 5 bold predictions: elevated inflation risk, weakening economic growth, interest rate volatility, housing shortage to continue, and inflation-resistant hard assets are going to be favored. That's gold, that's real estate, right? So I think that we'll see more capital shifting over into the commercial real estate space over the next year as a result of all of these forces that have come into play. So with that, I'll wrap it up. I'm John Chang. Hopefully you're listening to my podcast in partnership with Best Ever, The Horizon with John Chang. You can also find me on LinkedIn. And of course, all of our research is available on marcusmillichap.com. So thank you.
But here we go again.
You know it ain't my time.